What if you could actually calculate exactly what a stock is worth before you even think about hitting that buy button? Welcome to the Fox of Wall Street's guide to building a discounted cash flow model. Today, we're completely decoding the exact valuation method that Wall Street analysts use every single day.
We're moving way past that fleeting market sentiment, the daily headlines and the emotional trading. We're going to build a model rooted in pure mathematical truth. Yep, we're building a DCF model entirely from scratch.
Here's the blueprint for today's explainer. First, an intro to DCF, then projecting free cash flow, WACC and discounting, terminal and enterprise value, conducting a sensitivity analysis, and finally, common mistakes to avoid. Let's get right into it.
Section 1. Introduction to DCF, Valuing Fundamentals.
So what is this thing? A discounted cash flow, or DCF model, basically estimates the intrinsic value of a company. How? By forecasting its future free cash flows and then discounting them back to their present value. It's honestly one of the absolute most relied upon valuation methods for U.S. equities, precisely because it focuses strictly on business fundamentals. Look, a DCF doesn't care if a stock is trending on social media. It only cares about cold, hard cash, specifically the cash the business is projected to generate.
Moving to Section 2, Projecting Free Cash Flow, the 6-step blueprint.
Okay, so how do we actually build this thing? The workflow starts by projecting a company's revenue out for the next 5 to 10 years, right? Then you estimate the operating margins and taxes to figure out what's actually left over. Those projections are what lets you calculate the free cash flow. After that, you estimate the terminal value for the years way out beyond your forecast, discount the whole thing back using WACC, and finally, adjust for cash and debt to find your literal per-share value.
Now, the absolute engine of our model is the free cash flow to the firm. This is the actual cash a business generates. You start with EBIT, and you multiply it by 1 minus the tax rate. Easy enough. Next, add back those non-cash expenses, like depreciation. But wait, we can't stop there. You absolutely have to subtract capital expenditures, the money they're spending on physical assets. And finally, subtract the change in working capital. Boom! You've got your free cash flow.
All right, Section 3, WACC and discounting, the time value of money.
Once we have those future cash flows forecasted, we run headfirst into a fundamental law of finance. Future dollars are just worth less today than present dollars. Thanks to inflation and investment risk, a dollar you get 10 years from now just doesn't buy what a dollar in your hand today buys. So, to account for this, we discount those future cash flows. We use the weighted average cost of capital, or WACC. Think of WACC as a blend of the company's cost of equity and cost of debt. It essentially represents the target return expected by the investors, based on the company's exact capital structure.
Let's actually look at some realistic assumptions from the Fox of Wall Street guide so you can see what these inputs really look like. In this example, we're assuming an 8% revenue growth rate, a 22% EBIT margin, and a pretty standard 21% tax rate. We're applying an 8.5% WACC to discount our cash flows and setting a fairly conservative 2.5% terminal growth rate. Now, write this down. Your DCF is literally only as good as these exact assumptions. If you put garbage in, you're going to get garbage out.
Section 4, Terminal and Enterprise Value, Putting on the Roof.
So obviously, we can't realistically project a company's individual cash flows year by year until the end of time, right? We need a way to value the company beyond our 5 to 10-year window. This brings us to the terminal value. We calculate this using the Gordon growth formula. You just take your final year's free cash flow, multiply it by 1 plus your long-term growth rate, and then divide all that by your WACC minus the growth rate. This gives you the total value of the company moving into perpetuity. And once you have that massive number, you bridge from enterprise value to equity value by adjusting the balance sheet.
To find the intrinsic value per share, you just sum up the present values of your forecasted cash flows and your terminal value. Then you subtract net debt and add back any excess cash they've got lying around. Finally, you divide that total equity value by the diluted shares outstanding. And there it is. You now have a precise, mathematically calculated share price to compare against the current market price. This is exactly how you see if a stock is undervalued or overvalued. Before we move on to the all-important stress test, if you're enjoying this content, don't forget to like, share, and subscribe to Fox of Wall Street so you never miss our weekly investing and stock market education explainers.
Section 5, Conducting Sensitivity Analysis, the Earthquake Test.
As I said earlier, a DCF model is entirely dependent on its assumptions. And because we're essentially trying to predict the future here, we absolutely must perform an earthquake test. We call this the sensitivity analysis. A sensitivity analysis heat map reveals how your final valuation swings when you tweak those core inputs.
Just a tiny fraction of a percent change in your WACC or your terminal growth rate will totally alter your final valuation. By looking at a range of outcomes, say a 2 to 3% growth rate or an 8 to 9% WACC, you protect yourself against being overly confident in just one single rigid target price. It's a real game changer.
All right, Section 6, Common Mistakes to Avoid, Protecting Your Model.
To wrap up the mechanics, we need to talk about the real-world pitfalls. These are the silent killers that frequently trip up beginners building their very first valuation models. Plugging in wildly unrealistic growth assumptions just to make the math fit a narrative you want to believe? Massive error. Another huge trap is ignoring share dilution. I mean, if a company is constantly issuing new stock, your slice of the pie, your per-share value, is going to shrink. Plus, you absolutely must ensure consistent treatment of debt and make sure to correctly reconcile the company's historical financial statements before you ever even start forecasting the future.
Want to know how professional analysts improve their DCF accuracy? Here's a pro tip. Do not build your model based on flashy news headlines or simplified financial websites. For U.S. equities, you should always be using the company's latest official SEC filings. We're talking the annual 10K and the quarterly 10Q. Combine those with direct management earnings guidance as the foundation for your assumptions. Always go straight to the source.
Look, as incredibly powerful as a DCF model is, it shouldn't exist in a vacuum. The guide hits the nail on the head here. A DCF should always be combined with a comparable company analysis and, frankly, a qualitative assessment of a company's competitive advantages. The math can tell you exactly what the cash flows look like, sure, but the qualitative analysis tells you if a company actually has a wide enough economic moat to protect those cash flows from competitors over the next decade.
So, we've walked through the entire 6-step blueprint, from projecting future revenue all the way to calculating the intrinsic value per share. The question now is, are you ready to pull a 10K and build your first model? Get in there and practice these steps using real companies. Dive into the data yourself and see what actual intrinsic values you uncover. If this explainer helped you understand discounted cash flow models, hit like, subscribe, and share Fox of Wall Street with your fellow investors. Thanks for watching, and we'll catch you next time.